The Airbnb collapse is real. Revenues are down nearly 50% in cities like Phoenix and Austin. Watch out for a wave of forced selling from Airbnb owners later this year in areas hit hardest by the revenue collapse. That is a tweet by Nick Gurley, and there's a lot of misinterpretation going on here. And honestly, that title there, revenues are down nearly 50% in cities like Phoenix and Austin, is not true at all. I want to break down what is actually in this chart and then show you guys the relevant data from these markets so you can have a better understanding of how to digest this info. I have a lot of students with properties out in Phoenix. I have students with properties in Austin. I have properties in the Sevierville, Tennessee area, and tons of students as well in a lot of these markets. But it shows Phoenix at a 47.2% drop. Now, I do want to make a note that this is not revenue. So stating revenues are down by 50% is a lie. What the chart is actually showing is a percentage change in revenue per available listing, or RevPAL. If you guys are familiar with AirDNA, a similar way to look at this is RevPAR, revenue per available rental. And the way RevPAR or RevPAL is calculated is taking the total market revenue on a given month, a given year. In this case, they're looking at year over year from May, right? From 2022 to 2023. So you're taking the total market revenue divided by the number of active rentals, and that gives you the revenue per available listing. So this is saying that revenue per available listing was down 47%. The reason why this is a misleading tweet by Nick is because if you actually go look at the revenue, which I have up right here, in May, and this is for Phoenix, in May of 2022, the revenue for just houses/villas was $10.9 million total market revenue. In May of 2023, for house/villa, the total revenue is $16.8 million, which is like a 50% increase. So it's complete opposite of what he's suggesting in the title of that tweet. Now, what we do have to be cognizant of are a few different factors, right? RevPAR or RevPAL is just one of the factors when considering investing into a market. It is an important one to look at, certainly, because you want to see what available supply is in the market compared to the demand. But first and foremost, not all rentals are created equal. So although there is an increase in number of rentals here, so if you go to the overview page on AirDNA, in Phoenix, you can see from, let's see, Q3 of 2022, there were 7,100 active rentals. And in Q2 of 2023, there are 9,500 active rentals. So that is quite a big increase. We're actually seeing it trend back downwards now. So there is going to be a balancing act like any industry with supply and demand. The rental growth or the supply has increased, but so has the total market revenue. So the other reason why we're seeing such a big decrease in May from 2022 to May of 2023 in RevPAL is a couple different factors. One, supply has increased, but two, the May of 2022 is kind of like the end of the post-COVID travel boom. So there was an obscene amount of travel demand in a lot of markets that were more friendly to travelers during the COVID pandemic, Arizona being one of them. So there was a great demand there in 2020, 2021, and the first half of 2022. So a lot of investors did end up overpaying for properties as real estate boom happened, interest rates were still low, and demand was also soaring. So people were cashing in. Now we're at a tipping point, and to Nick's credit here, there are people that overpaid for short-term rental properties and did not do proper research, right? They just looked at 2021 data and said, oh man, everyone's crushing it, I'm gonna do the same. You have to understand that competition's ramping up. So you have to take that into consideration. Also, not just looking at the past year's worth of data, but you have to look at the past like 3 to 5 years worth of data and some of the future looking information to make more accurate predictions on how your short-term rental may perform. We're gonna also look at Austin, Texas. So in that same tweet, again, stating that revenue is down. If you look at the total market revenue in May of 2022 for Austin, it was for just houses, it's not including apartments, unique stays, or BNBs, was $26 million. In May of 2023, $29 million. So it actually went up a little bit, not as much as Phoenix did. But the supply also, my guess, is also probably went up. And if you're looking at Austin on the rental growth or the supply in a market in Q3 of 2022, 12,689 rentals. And then Q2 of 2023, the most recent, report put out by Airbnb is 13,787 rentals. So it has gone up a tick, but so has revenue. Also, Airbnb puts out relevant information in the form of blog posts. If you guys go to Google and search Airbnb blog, you can go up and look at all of their blog posts and press releases. And the one that came out in July about the metrics for June of 2023 tell a bit of a different story for just like the short-term rental industry as a whole, not just hand selecting certain markets that had bad month over month for May data. So RevPAR, revenue per available rental, which is what we've been talking about, increased by 0.3% year over year across all short-term rental data for the entire United States as a market as a whole. Available listings reached 1.53 million, which is up 15.2%. So the supply is definitely going up. Total demand for nights being booked rose by 14.3% year over year. And then occupancy was 1.1% lower year over year at 64.5% as an average. And that is actually up 7.1% as compared to 2019. So occupancy is a little bit less. However, with the amount of demand going up or available listings up 15%, I would consider the demand quite strong considering occupancy barely dipped at all. And then average daily rates rose by 1.5% year over year. And then the nights booked, the number of nights booked increased 25.6%. So this goes to show that overall demand for short-term rentals is still really strong. There's still a lot of new people getting introduced to Airbnb and Vrbo and still deciding to book there versus hotels. Even though supply is going up, it still is sustainable. But it just goes to show, again, it just depends which market you're in. Some are doing much worse off when it comes to the data, and some are doing much better. This is looking at the entire US, and of course, that one article was just looking at hand-selected markets at probably the worst available data for that specific month to make the article seem better. Something else I found interesting from the AirDNA article here was that demand growth in the month of June of 2023 increased and exceeded 10% in all different location types. And the highest increase was actually in small city or rural locations where demand increased almost by 25%. And then the least amount of growth occurred in destination or resort on coastal areas. But you can see like mid-sized city and small seem to have the strongest demand growth. So that might tell you a better picture of where, if you're a new investor, where you might want to look to invest in. A lot of the bigger vacation markets have probably a higher level of saturation than some of these small or rural areas. So you might want to consider being a bigger fish in a small pond, I often say a lot, versus a small fish in an ocean, which would be the bigger market. There are so many people making boatloads of money in short-term rentals. I am one of them. The key takeaway for me, though, is it is getting more competitive, and especially in big markets like the Smoky Mountains of Tennessee or Phoenix and Scottsdale or Austin, Texas. So it's critical to stand out. You have to compete on design. You have to understand who is going to be renting your place. Is it younger friends in their 20s? Is it families with children visiting? Is it work travelers, right? What amenities do you need to provide in order to get premium rates and also a higher occupancy rate? If you do not understand those factors and then you stand up some run-of-the-mill property because, hey, I saw some TikTok video of somebody making boatloads of money in Austin, Texas, so I just said, if I just buy anywhere in Austin, I'm going to succeed. Like you're just shooting in the dark, and honestly, you're probably going to end up making a poor investment unless you just get lucky. So you have to differentiate. You have to understand both historical and some future-looking data and trends in your market. You have to know who you're renting to and why, what the seasonality is going to be like, and what your expenses are. What's the price of real estate? What's the mortgage going to be? What are the cleaning fees? What are the other operational fees going to be? And ultimately, how hard is my money working for me? What is the ROI in this case? So just remember, you have to look at the market holistically and not just one particular factor for 1 month over 1 year over year comparison. So I feel like this article really was just clickbaity, and it failed to give all of the information necessary to make that assumption, that Airbnbs are tanking and there's a major collapse pending. Because I'll be honest, we just had a record month with total revenue for our 7 properties this past month in July. So just be careful who you're listening to. And if you guys want more relevant information, looking at the greater picture, do me a favor, subscribe to my page. I'll go more in depth and look at the highs and the lows and all sorts of other info that could be helpful for you guys.